Hiya, my name's Claire Trythall, and I work in Treasury Risk, but most of my experience throughout my career has been in interest rate risk in the banking book. So today I'm going to talk you through the EBA regulation and the main differences between the new regulation and the previous regulation from 2018. So I'm going to talk through the key changes, and then I'm going to go through a couple of examples on assumptions and why you need to be careful with your assumptions. I'm also going to go through non-parallel shocks because that's something that's quite unique to the EBA. So non-parallel shocks is not a BIS regulation, so it's not required, but the EBA mandate that you have to do non-parallel shocks, and I've got an example of why that's important as well. So the guidelines were published in October 22 to replace the 2018 guidelines. So there's a lot of similarities between the previous guidelines, but there's an extra element of risk management in interest rate risk and in CSRBB as well. So these are the four main changes that I'm going to talk about today. So the one is there's a lower floor on the interest rate shocks. So the negative rate floor is lower now than it was before, which reflects a higher probability of negative rates today compared to 2018. There's also stricter regulatory capital limits. So previously this was 20% and now it's gone to 15%. There's a mandate for calculating NII, where before your EVE you were mandated to calculate EVE in a certain way. You didn't have that for NII, whereas now you do. There's also a maximum tenor for deposit assumptions, so you can only use fixed deposit assumptions up to 5 years. So the first point is on the lower floor for the interest rate shocks. So previously the floor was minus 100 bips. So this was during 2018, it was kind of the lowest it would go at that point in time. That seemed like a severe but plausible shock, whereas now that's gone even further down to 150 basis points. The tapered floor was previously over a 20-year period, so it started at minus 100 bips. And over 20 years would go back towards zero, whereas now that's over 50 years that it goes back towards zero. So that reflects the new environment that we're in, where negative rates are more likely. So this modification acknowledges that it's more likely that we'll have negative interest rates in the future. So even though interest rates are high right now, it's just reflecting that probability that during COVID and the forward curves that we saw then, even the Bank of England had forward rates that were negative on the forward curve. So that just reflects these changes that we've seen in the past couple of years. So the next point I'm going to talk about is the stricter regulatory capital limit. So this is a reduction in the overall amount of capital that they want you to hold. So previously, if you had your interest rate risk exposure was above 20%, then because it's more than 20%, then they would say that that's risky and you have to report it to the regulator, whereas now that's 15%, so they're being more strict with it. As well as that, the denominator's changed. So instead of being own funds, it's now tier 1. So that is generally a smaller number, so that's more strict as well. The next point is the supervisory at large test for NII. So there's a set way that you can calculate your NII. There's also a standardised approach. Some banks may find it more useful if they don't have satisfactory internal measurement systems. They may find it easier to use a standardised approach. There's a detailed assessment process, so the approach for EVE and NII is categorised is essentially just you're changing EVE and NII with your net buckets on your repricing gap. So the next point I'm going to talk about is the deposit assumptions. So these two charts show the difference between when you use a deposit spreading assumption and when you don't for your repricing gap. So the charts show the same bank and they have the same repricing gap and they have the same asset and liability positions. But the difference is one's contractual, one's behavioural. So one's spreading their current accounts and one's not spreading their current accounts. So you can see the current account position as around about minus 100 billion for the contractual, and then that's spread across the gap for the behavioural. So this shows how, if you've got a current account spreading assumption, this is how it would be shown on your gap if it was spread out to 10 years. And it's important to know what assumptions are being used for your repricing gap as well, because if you're kind of in senior management and you're not working on the hedging every day, you don't see it every day, you might see that you've got a net gap that looks quite small, like that behavioural repricing gap on the bottom there. And it might look like you don't really have much interest rate risk because the assets are offsetting the liabilities. So it looks like you don't really have much interest rate risk, but really that could be down to using assumptions. So in this slide I'm talking about where you've used assumptions versus where you've used hedging. In the first scenario, we're talking about the same bank but under two different scenarios. So one, the bank has used hedging to hedge their fixed assets, and the other one, the bank has taken their current accounts and they've spread it but they've not done any hedging. So you'll see in the following slides that there's a change in the net interest income between if you use that current account spreading assumption compared to if you actually execute some swaps. And I'll also go into an example of what happens when interest rates increase. So your NII change over a BAU kind of period, and then your NII when rates have increased. And an analogy that I like to use is that it's kind of like car insurance with your NII, where you can like make your monthly payments on the car insurance, and that's like your hedging. So if you weren't to do enough hedging, it'll look like you're in a more favourable position from your income because you're making more money every month, and that's off your hedging. So that's your NII. But if you got into a car crash, or if interest rates went up significantly and there was a big shift in the curve, then you'll have a large hit, and it would be an instant hit, and that's the value of the car or to the value, which is your ADE. So in this example, you can see how using the current account assumption would be more favourable by 0.5%. So this is in kind of like a BAU scenario where somebody might have used current account spreading assumptions on the left and they've done hedging on the right. So you can see that the hedging is slightly more expensive because they receive 0.5 but they're paying 1%. So the difference is that they make 0.5% less. And that's the difference between if they were to use a current account spreading assumption and if they were to do hedging with swaps. So the difference is that they do make more net interest income in the scenario with the assumption spreading. So in the next scenario, we see where interest rates have gone up and how this impacts on both the repricing gaps and on the net interest income. So often there's like consequences of maintaining low deposit rates. So with the current account assumption, basically you're saying that you're 100% sure that your current accounts are going to stay fixed for a certain period of time. So if you're using that against 5-year assets, you have to be 100% sure that those current accounts are going to stay at 0% and that they're also not going to leave the bank if interest rates do go up significantly. So one way that I like to test the assumptions is to say if interest rates went up to 20%, which is a very severe scenario, but if they did go up to 20%, can we still say that we're going to give current accounts 0%, and will they stay with the bank when everybody else is giving around 15% on the current accounts? Will they stay with the bank getting 0% if interest rates were 20%? And if the answer is yes, then that's fine, use current account assumptions. But if the answer is no, then that's where you need to check. So you can see in this scenario, this is a scenario where the current account assumptions prove not to be true. So on the left, what's happened is their current accounts have left. So because they didn't pass on the rate increase to their current accounts, then they've left, which has meant that the bank has had to get in new funding at the current higher market rate. So instead of having that 0% funding, they're in a situation where they're struggling with liquidity. They need to get funding in quite quickly. They need to get it at the current market rate, which is 4%. So you can see now the net interest income is minus 2.5%. Whereas with the hedging on the right, you can see that the net interest income is still 0.5%, so it's locked in at that rate. And that's because even though the funding's more expensive and they're having to pay more for the funding, they're getting that received floating leg on the swap. So because the received floating leg on the swap is going up, that covers the additional cost of funding that they might have to get at the current market rate.
Yep.
So the next section that I'm going to go on to is the importance of non-parallel shocks. So non-parallel shocks are different to parallel shocks in that parallel shocks are saying how much will my balance sheet change if rates increase by 2%, for example, all the way across the curve, or decrease by 2% all the way across the curve. It doesn't do a short increase and then a long decrease, whereas non-parallel shocks are doing changes in the curve, so it might be higher at one end and lower at the other, or vice versa. So this example here is the parallel up 250 scenario. So basically what we're saying is interest rates have gone up by 2.5%, and how does that impact on the balance sheet and on your EVE? So this is kind of a good example to show how parallel shocks can sometimes hide your true interest rate risk. So the reason for that is, you can see here you've got a 40 million liability in your 1 year bucket. So if your funding is sitting in the 1 year bucket and you're taking 1 year bonds, then if you've got a 40 million open position there, and then you've got a 10 million open position in the 5 year bucket, those are both going to cost you around about $1 million EVE. But the one is $1 million benefit to EVE, and the other is $1 million loss to EVE. So they offset each other and make it look like your EVE impact is zero. So if you're somebody that's just looking at the EVE numbers and just looking at the parallel shocks, you might not know that you've got significant open positions like that on your gap, because if they're just the right amount, they can offset each other in a parallel shock. And now this shock here is the steepener. So basically the steepener shock is underneath the base curve to begin with, and then over time it goes above the base curve. So where the curve of the shock is lower than the base curve, then that means that the liabilities are going to incur a negative EVE value. So you can see there, because it's lower, the liabilities are going to be hit on that side. And then because it comes above the base curve after 4 years, then that means that any assets that are sitting in the 5 year are also going to have a negative EVE value. So you can see here that both the asset and liability position incur a negative EVE value. So that exposes that there's open positions that before they were hidden, and now with the non-parallel shock, which is a steepener, you've got a double hit. You've got a hit in the 1 year and a hit in the 5 year that add together to show that you've got interest rate risk there. So you can see here, even though the non-parallel shocks tend to be less of a severe change in interest rates, but because they change shape, it allows you to see where you've got open positions where parallel shocks might offset them against each other. So you can see from these two comparisons that the parallel up scenario is showing almost no interest rate risk. So if you were a senior manager looking at these results, if you were looking at the top results and you didn't look at the repricing gap, then you might think that you've got no interest rate risk and that you're well hedged. But by looking at your non-parallel shock exposures, you can kind of understand, well, I might have zero result for a parallel up or a parallel down, but if my non-parallel shocks are showing I've got interest rate risk, then you need to investigate further, because it's likely that you've got open positions at different points that are offsetting each other. So now going on to the rationale behind the EBA regulation. So these are kind of examples of where the EBA have their guidelines that protect against interest rate risk in different ways. So basically the first one is, so Silicon Valley Bank was not mandated to evaluate their economic value of equity. So this is why a lot of the US banks were the ones that collapsed, because they were the small US banks, they were the ones that weren't regulated by the EBA. If they were regulated by the EBA, then they would have had to report their EVE. And by reporting their EVE, then they would have been more in control of managing it. The regulator would have had sight of what was happening, and they would have been more actively managing their exposure to interest rate risk. So the second point is, so Silicon Valley Bank, they failed this year. What they were doing was they were taking their current accounts and they were spreading them across the gap out to about 10 years. So the average life that they were spreading out to was about 6 or 7 years. And they were doing that to buy assets which yielded about 1.5%, and the average life was about 6.5, 7 years. So those assets were not hedged, but they were hedged with an assumption, which was the assumption that those current accounts are going to stay with Silicon Valley Bank forever. They're not going to increase in interest rate when rates go up. But in reality, what happened was interest rates went up. It was about 5% in the market. And customers decided that they can get a better rate elsewhere, they can buy a bond. So they started to slowly see their current account base decrease over time. So because they didn't have any actual hedging on their assets, they didn't have any increase in the received leg of the swap to offset that increase in the funding costs. So what they tried to do was they tried to then increase the rate of the current accounts. So even though they'd had that assumption that current accounts are 0%, they tried to increase the rate to around 1%. But when you've got rates in the market at 5%, then 1% isn't really going to make a difference to your customers. And also by increasing that 1%, they were then impacting on their capital and making a loss to their P&L. And the second point is that because SVB also had that concentrated funding structure, it meant that by having all those current accounts and all their funding was in current accounts, they didn't use any fixed bonds to offset the assets, they didn't diversify their funding source. Then that's also why they experienced such a significant run on the bank. So the second point is that the mandatory capital reserves for EVE under EBA would have meant that the EBA would have been notified, or the regulator would have been notified when there was issues of interest rate risk. So it wouldn't have taken to them collapsing for people to retrospectively look and say, oh, they had a current account assumption, they didn't actually hedge, this is where they went wrong. They would have been able to step in earlier and say, why is your EVE looking like this? What can we do to change it? Do we need more hedging? But because they weren't under EBA regulation, they didn't have to report their EVE, so they omitted it in the final year when they were reporting their financial accounts. And finally, utilising the non-parallel shocks could have helped to reveal where there's imbalances in asset and liability offsets on the repricing gap. So like I mentioned before in the examples, these can be obscured and you might think that you've got a flat gap, but the non-parallel shocks will expose that. So in conclusion, the new EBA guidelines, they mark a significant shift towards recognising and managing the nuanced risk of non-parallel interest rate shocks. So the non-parallel interest rate shocks, the EBA have had them since 2018, so they're not new in themselves, but they're something that's unique to the EBA because that's not a global requirement to do the non-parallel shocks. But you can see the advantages of using non-parallel shocks to expose those open positions. You can see that the EBA has implemented new measures that will help to prevent similar situations that we've seen in the past. So for example, we saw Silicon Valley Bank spreading the current account assumptions out to 10 years, while the EBA has put a limit on it that they can only do that to 5 years now as a maximum. So they're looking and seeing what's happened in the past couple of years and how do we make sure that that doesn't happen again going forward. The next point is that there's a necessity to review existing assumptions that underpin financial models. So this kind of demonstrates that the EBA has an awareness that there are pitfalls in using assumptions, and you have to be quite certain that your assumptions are going to be accurate or as close to accurate as possible, and that you're not overestimating any of your assumptions, because that's where a lot of banks go wrong. There's also a mandate for more advanced analytical models, so that the interest rate risk is captured better, and dynamic modelling that reflects the current market realities, such as having those negative interest rates modelled in. And the EBA guidelines provide insight into areas where historically assumptions may falter. So this allows for a more conservative and informed outlook on potential market shifts, and overall gives a more robust position for a bank to be in, and there's no surprises when interest rates change because they know that they've sufficiently hedged and they're in a strong position. So the next point is that it's not just about regulatory compliance. So even though the EBA guidelines are regulation, it's more kind of like a best practice. If you want to manage your risk well and you want to be protected against interest rates changing, it's more like a strategic risk management. So it's not just a compliance exercise, but it's actually beneficial for your bank to be doing these things anyway. It's good practice. And finally, there's collective engagement in updating risk management practices to align with EBA's vision, because they want banks to be more unified so that banks can be more easily compared to each other, and that they're better equipped for challenges that lie ahead. And I think we're going to take questions in a Q&A, but thank you everybody for listening.